Are we headed for another real estate crash? Jamie Dimon, CEO of JP Morgan Chase, is worried. Rising interest rates could mean big trouble for property owners and the economy. A recession could send property values tumbling, leaving investors and banks in a financial nightmare. Could this be the next 2008? It's time to secure your finances and find cost-effective ways to adapt. If you're a business owner or investor, it's time to secure your financial footing and find ways to adapt. One way to future-proof your business is with clever, cost-effective marketing. Traditional advertising costs can eat away at your bottom line during tough times. That's why you need Workerty.com. It's a free platform for business listings, job postings, product and service promotion, and even finding great deals. Whether expanding your customer base, attracting new talent, or stretching your marketing budget further, Workerty.com is the solution that will relieve your financial stress in an uncertain market. Setting the stage. Let's be honest for a minute. The economy's been on a roller coaster ride lately, and there's a growing sense that the party might end. And who better to break down the situation than the financial world's ultimate insider, Jamie Dimon? Think of him as the guy who sees the financial storm brewing long before most of us feel a raindrop. Dimon's been in the game for decades, rising from his early days as a management consultant through some of the biggest banks in the world until landing as CEO of JP Morgan Chase, a true powerhouse of a financial institution. When he speaks, everyone listens. His insights aren't based on guesswork. He has a front row seat to the global economy, the kind of access that lets him see the whole picture. So, here's the problem. Think about the real estate market. For years, it's been fueled by super low interest rates. Cheap money made borrowing cash to buy properties easily, propelling prices to ridiculous levels. But now, inflation is a severe problem, and central banks are stepping in aggressively by raising interest rates to try to cool things down. That means getting a loan is about to become much more expensive. All of this could throw the whole real estate market out of whack. He warns that investors buying high-priced properties could be heading for serious trouble. If the economy hits a recession, those pricey office buildings and luxury homes could suddenly lose a chunk of their value. That leaves borrowers owing more on their mortgages than the properties are worth. And who gets stuck footing the bill? The banks who gave out those loans in the first place. Dimon's concerns. Let's cut through the financial jargon and discuss something most people get: rising interest rates. Here's the deal. Those past low rates were like rocket fuel for the real estate market. Getting a mortgage was cheap and easy. But as we all know, what goes up must eventually come down, and interest rates are no exception. The Federal Reserve is slamming on the brakes to try to stop inflation. Their weapon of choice? Raising interest rates aggressively. Suddenly, that dream home or that sleek commercial property becomes much less affordable with a more significant monthly mortgage payment. That means demand could plummet, potentially causing those sky-high prices to drop. This is where things get tricky, especially for investors who jumped into the market at the peak when things were red hot. Jamie Dimon is blunt. If rates go up and we have a recession, there will be real estate problems, and some banks will have a much bigger real estate problem than others. Let's break that down. See, if the economy slides into a full-blown recession, it's not just home values that take a hit. People lose jobs, businesses struggle, and those shiny new commercial buildings sit empty while leases get canceled. All of this spells big trouble for borrowers. They might struggle to make their inflated mortgage payments, and some may face the nightmare of owing more on their properties than they're worth. Think of it like buying a car for $50,000, only to find out it's suddenly only worth $30,000. You're still on the hook for that whole loan. Now, who gets burned in this scenario? The banks. They lent out the money during the boom times. If their borrowers default, banks could find themselves owning a whole bunch of properties they never wanted. And those properties just lost a chunk of their value. Suddenly, what looked like a significant investment can become a massive headache. Could this spark a wave of foreclosures and tank the economy like in 2008? He thinks it's a real possibility. Of course, the optimists will argue that the financial system is more vital now and can absorb losses without collapsing entirely. They argue for a soft landing, a gentle economic slowdown instead of a crash. But here's the thing. Jamie Dimon doesn't do sugarcoating. He sees the clouds on the horizon. Is he right to worry about rising rates, a potential recession, and the fallout this could have on real estate? Will his pessimism turn into a self-fulfilling prophecy? Only time will tell. Impact of interest rates. Let's explore why this cap rate situation is a significant cause of Jamie Dimon's concerns. Remember, cap rates are like a risk meter for real estate investments. In the good old days of cheap money, low interest rates translated to low cap rates, making investments look extra attractive. This ignited bidding wars and drove up property prices to astronomical levels. The problem is that those super low cap rates created a false sense of security. As interest rates inevitably rise, so do cap rates, throwing the entire equation out of whack. Let's break this down with an example. Imagine you bought an apartment building generating $100,000 in annual income. Back when cap rates were low, that income stream justified a purchase price of $2 million. But fast forward to today, with higher cap rates in play, that same income might only support a $1.5 million valuation. That's a staggering drop in value, and a single dollar of revenue is recovered. Now, imagine you are an investor who jumped into the market at the peak, fueled by the frenzy of rising prices and low cap rates. You took out a hefty loan, convinced that rising rents and growing property values would guarantee a winning investment. Suddenly, interest rates climb, cap rates spike, and your property's value plummets. You could owe more on your mortgage than the building is worth. That's the dreaded underwater scenario, a financial nightmare for everyone involved. Are you feeling the pressure yet? Don't despair. If you need help getting your business, products, or job search noticed in the crowded online world, there's always a solution. Workerty.com. It's your secret weapon for free marketing, where you can list your business in our free directory, post free job openings to attract top-tier talent, sell pre-loved items in our free marketplace, promote your services or affiliate products with free advertising, score amazing deals and offers. Workerty.com is available across the UK, USA, and globally. Ready to give your marketing a boost without busting your budget? Visit Workerty.com today and unlock the full potential of free advertising. Now, back to those cap rates. Let's think bigger. Imagine those massive commercial real estate projects, sprawling office complexes, and gleaming skyscrapers, all financed with astronomical loans. Rising interest rates threaten these developments. If businesses struggle to pay sky-high rents or investors start backing out due to increased risk, those projects could lose substantial value. Banks become the unfortunate owners, lending slows down, and the ripple effects can drag down the broader economy. Understanding cap rates is critical when comparing real estate investment opportunities. However, more clarity and consistent methods in calculating their results are often needed. For instance, some investors might include costs like management fees when determining net operating income, NOI, while others won't, leading to vastly different cap rates. This can significantly distort a property's accurate valuation. Relying solely on historical income to create a cap rate can also overvaluate a property, since projected income often carries more risk. So, could this trigger a crash? Jamie Dimon thinks so. Rising interest rates and the dramatic impact on cap rates are flashing bright red warning signs. Some might dismiss him as an alarmist, but his track record is undeniable. He sees the gathering storm clouds, and we must decide whether to scramble for cover. Economic factors beyond Dimon's control. So far, we've focused on rising interest and cap rates and how they directly impact real estate. But here's the thing. Jamie Dimon is more relaxed about one sector of the economy. He's looking at the whole picture. What he sees isn't pretty. Remember, the economy isn't an isolated machine. All these invisible gears are turning. If a few start grinding, it can have a ripple effect. He has repeatedly expressed worries about government spending and the lingering impacts of the pandemic. Think about it. All that money pumped into the economy to keep it afloat has to have consequences, right? This isn't just fear-mongering from Wall Street. He sees uncertainty in the market's ability to adjust if problems multiply quickly. He said it could take several years for the fallout from current events to play out honestly, which means a lasting economic slump, not just a quick blip. Here's where things get especially concerning. He highlights how forces outside his control could further derail the economy. For instance, an unforeseen event, like a geopolitical crisis, could send shockwaves through already weakened markets. Or, ongoing government spending could keep inflation stubbornly high, forcing the Federal Reserve to hike rates even more aggressively, potentially triggering a significant recession. This lack of control is frustrating for someone like Dimon. He's built a career on careful calculations and analyzing risk, but there are simply too many variables that could throw everything into chaos right now. This explains his cautious tone and focus on preparedness. It's not about predicting a specific disaster, but ensuring we're all as well insulated as possible if the downturn arrives. So, what does this all mean for the average person? While it's tempting to tune out the doom and gloom, remember, Jamie Dimon doesn't have a crystal ball, but he does see the warning signs flashing. Now might be the time to reassess your financial situation. Do you have enough savings to weather a job loss? Are your investments properly diversified to handle potential volatility? Taking some practical steps now could save you severe headaches down the road. The bottom line is that while Jamie Dimon raises the alarm, these warnings are about much more than protecting his investments. The financial decisions made by banks, governments, and individuals all create our economic landscape. He might be urging us to prepare for the worst, but there's still the chance we can navigate these uncertain waters. It's about intelligent planning and being proactive. Speaking of being proactive, if you're ready to take control of your business, products, or job search without breaking the bank, it's time to check out workerty.com. It's your one-stop shop for free advertising, deal finding, selling, and job posting. Visit workerty.com and see the difference that free marketing can make. Thanks for watching. If you found this video insightful, please hit that like button, subscribe to the channel, and remember to turn on those notifications so you'll be the first to know when our next video drops. We'd also love your thoughts on Jamie Dimon's warnings and the broader economic situation, so share those in the comments below.